Is the era of sub-$30 silver over for good? For decades, the silver market has been governed by paper derivatives, allowing large financial institutions to manage volatility. But a massive structural shift is occurring. Physical industrial demand is draining global vaults, and the leverage used to keep prices down is breaking. In this deep dive, we analyze the mechanics of the silver market and why the cheap silver window may have just slammed shut. The following content is for informational and educational purposes only. It is an analysis of market data and economic trends and should not be considered financial or investment advice. All markets involve risk. Do your own due diligence or consult a certified financial advisor before making any investment decisions. Look around at the economy today. The price of everything is exploding. Real estate, food, energy, even used cars. We're living through a period of intense monetary debasement. Yet, there is one asset that sits incredibly at roughly half its all-time high from 1980, silver. For decades, silver bugs have asked the same question. How is this possible? How can the most electrically conductive metal on Earth, an essential component for modern technology, be so cheap when they are printing trillions of dollars? The answer is complex, but it boils down to one fundamental reality. For the last 40 years, the price of silver has not been set by the physical exchange of metal. It has been set by the trading of paper promises. Today, we are going to dissect the machinery that has kept silver cheap. And then, we're going to show you the undeniable data that suggests this machinery has finally broken beyond repair. We are witnessing the moment where physical reality overwhelms financial leverage. We have to ask the hard question. Is it already too late to buy cheap silver? Let's begin. To understand why silver has been so cheap for so long, you have to understand that there isn't just one silver market. There are two, and they rarely tell the same story. First, there's the physical market. This is the real world. Miners dig ore out of the ground. Refiners melt it into 1,000-ounce industrial bars. Companies like Samsung, Tesla, and solar panel manufacturers buy those bars to melt down and put into products. This market is governed by hard limits. You cannot print a silver bar out of thin air. It takes energy, time, and capital. Then there's the paper market. This is primarily the futures market, centered around exchanges like the COMEX in New York and the LBMA in London. In this market, participants aren't usually trading metal. They are trading contracts, legal agreements to buy or sell silver at a future date. This paper market was originally designed for a good purpose: hedging. If you were a silver miner and you knew you were going to dig up 1 million ounces next year, you might be worried the price would drop before you could sell it. So you would sell futures contracts now to lock in today's price. You were shorting the paper market to protect your physical business. That is a healthy market function. But over the last few decades, something changed. The paper market grew. It grew monstrously larger than the underlying physical market it was supposed to represent. Enter the large financial institutions, the bullion banks. These institutions act as market makers. Their job is to provide liquidity, ensuring there is always a buyer for every seller. To do this, they deal in massive amounts of paper contracts. Because these are just paper contracts, they don't need 100% of the physical silver to back every trade. They use leverage. Historically, on exchanges like the COMEX, for every 1 ounce of registered physical silver sitting in the vault available for delivery, there might be 100, 200, or even 300 paper claims trading against it. Think about that ratio. It's a game of financial musical chairs. As long as the music plays, and as long as 99% of the traders just want cash profits and don't demand the actual metal, the game works. The paper price is accepted as the real price. So how does this keep the price down? In the physical world, supply is inelastic. If demand spikes tomorrow, miners cannot just flip a switch and double production. It takes 10 years to build a new mine. When physical demand hits inelastic supply, prices must spike violently to ration the metal. But in the paper world, supply is theoretically infinite. If demand for paper contracts rises, the market makers can simply create more short contracts to meet that demand. They can dilute the market with paper supply in milliseconds. For decades, whenever silver started to rally based on real-world inflation fears or industrial demand, massive waves of paper selling on the futures markets would appear, absorbing that buying pressure and capping the price. Now, it is crucial to state this clearly to align with market realities. This is not necessarily about a smoky backroom conspiracy of evil bankers trying to hurt retail investors. Often, these banks are simply hedging massive over-the-counter deals they made with industrial clients, or they are managing their own books. They are agnostic to the price. They make money on the volume and the spread. However, the effect of their massive size and leverage is undeniable. Their ability to flood the market with paper supply has historically acted as a dampener on volatility. It has smoothed out the spikes that would occur in a purely physical market. It created an illusion of abundance. The world looked at the paper price, saw it was low, and assumed there was plenty of silver to go around. This mechanism, this massive leverage of paper over physical, is why silver remained cheap, even while the dollar lost 90% of its purchasing power over the last half-century. The price was set by financial flows, not geological reality. But every leveraged system has a breaking point. The paper market only functions as long as the physical market is asleep. As long as the industrial users are complacent, believing they can always get metal at the paper price, the illusion holds. But what happens when the physical market wakes up? What happens when the demand for the real thing becomes so overwhelming that the paper games no longer matter? We are standing at that precipice right now. The era of the paper-silver illusion is colliding with the hard wall of industrial necessity. In the next section, we will look at the data that proves the banks and the futures exchanges themselves are losing the ability to manage this market. We will look at the draining vaults, the green energy explosion, and the moment the music finally stopped. Welcome back. In section 1, we established the primary mechanism that has kept silver prices suppressed for decades, a massive paper derivatives market that used high leverage to create an illusion of unlimited supply. This system worked flawlessly as long as the physical market remained mostly dormant. But now, we need to look at the hard data that proves this era is over. The physical market has woken up with a vengeance, and it is beginning to break the paper machinery. We are witnessing a structural shift in the global economy that is turning silver from a financial trading card back into a scarce strategic industrial asset. Let's look at the undeniable evidence of the Great Drain. For most of history, silver's primary demand driver was monetary, coins and bullion or photographic film. Those days are gone. Today, silver is an indispensable industrial metal. It is the most electrically conductive, thermally conductive, and reflective metal on the periodic table. You cannot build the modern world without it. The driving force behind the current physical squeeze is the global green energy transition. This isn't a political statement, it's an industrial reality mandated by governments worldwide. Let's start with the 800-pound gorilla, solar energy. Photovoltaics, PV, is now the single largest source of industrial demand for silver. Every solar panel on a rooftop or in a desert farm uses a silver paste to conduct electricity. For years, the market assumed that solar manufacturers would thrift silver away, using less and less per panel to save costs. And they did, for a while. But that trend has reversed. The solar industry is rapidly shifting to new, higher efficiency cell technologies like TOPCon, tunnel oxide passivated contact, and HJT, heterojunction. These technologies are essential to meet efficiency targets, but there's a catch. They require significantly more silver per panel than the older technology. The Silver Institute projects that industrial demand for silver will hit a new all-time record high in 2025, surpassing 700 million ounces for the first time. The solar sector is the primary engine of this growth. This demand isn't optional, it's price inelastic. A solar manufacturer like Jinko Solar CA ain't just stop buying silver if the price goes to 50. They need the metal to build their product and fulfill their contracts. Then add in electric vehicles, which use far more silver than gas cars in their electronics and battery management systems. Add in the massive build-out of 5G networks and AI data centers, which all require high-performance silver contacts. We have created a world where government mandates and technological evolution are forcing an exponential increase in the consumption of a metal with a finite geological supply. So, demand is exploding. What about supply? This is where the math becomes unavoidable. For the last several years, the global silver market has been running a structural deficit. This means that every year, the world consumes more silver for industry, jewelry, and investment than the mines can dig out of the ground plus all recycling combined. According to industry data, 2025 is projected to be the 5th consecutive year of a significant market deficit. The cumulative shortfall over this period is massive, hundreds of millions of ounces. Think about that. For half a decade, we have been consuming more than we produce. How is that possible? How has the world kept turning? By draining the above-ground stockpiles. This is the most critical data point in the entire silver story right now. The paper market relies on a physical backstop. The silver bars sitting in approved vaults like the COMEX in New York and the LBMA in London. These vaults are the buffer. They are the savings account that allows the paper market to function. But that account is being raided. Since the start of the decade, and accelerating since the silver squeeze movement began in early 2021, the registered inventory on the COMEX, the silver available for immediate delivery to fulfill contracts, has crashed. From highs of nearly 150 million ounces, registered stocks have fallen by over 70%. We are seeing levels of physical inventory not seen in years, despite record-high paper trading volumes. Where's that silver going? It's leaving the financial system and entering the industrial supply chain. It's being melted down, turned into paste, and bolted onto rooftops across the globe. Once it's in a solar panel, it is effectively gone for decades. It is consumed, not hoarded. This is the moment the banks lost control. They haven't lost the ability to trade paper. They have lost the physical cushion that made their paper leverage safe. When you have record paper open interest backed by a dwindling puddle of physical metal, the leverage ratio spikes dramatically. The system becomes incredibly fragile. This isn't a conspiracy theory, it's inventory management. You cannot have infinite paper claims on a finite physical asset that is actively disappearing into industrial crucibles. The physical market is screaming that silver is scarce. The paper market is still pretending it's abundant. This divergence cannot last forever. Reality always wins. In the final section, we will look at the endgame. What happens when the industrial panic sets in? What is the trigger event that finally breaks the paper price? And what does the future hold for the price of silver? Welcome to the conclusion of our deep dive into the silver market. In section 1, we explained how the paper derivatives market used massive leverage to create an illusion of abundant silver, keeping prices suppressed for decades. In section 2, we showed you the undeniable data that the physical world has changed. Exploding green energy demand has created chronic deficits, draining the physical vaults that act as the backstop for the entire paper scheme. We have now arrived at the dangerous setup. We have a paper market that is leveraged to the hilt, betting on continued abundance. And we have a physical market that is flashing red warning signs of an imminent shortage. The banks haven't lost control because of some grand defeat. They are losing control because geology and industrial demand are fundamentally stronger forces than financial engineering. Now we have to answer the final question. How does this resolve? What is the endgame when the illusion finally breaks? For years, silver investors have waited for a squeeze driven by retail buying, millions of people suddenly demanding physical coins. While powerful, that's not what will ultimately break the paper mechanism. The trigger event will come from industry. Imagine you're a procurement officer for a massive company like Tesla, Samsung, or a giant solar panel manufacturer like Jinko Solar. Your job is to ensure the factories never stop running. A shutdown due to a lack of raw materials costs millions of dollars a day and devastates your stock price. For decades, these companies have operated on just-in-time inventory. They rely on the bullion banks to deliver silver exactly when they need it, trusting that the COMEX and LBMA always have supply. But, as we saw in section 2, those vaults are emptying. The trigger happens on a quiet Tuesday morning. One of these major industrial giants tries to place a large order for physical silver bars to secure their production for the next quarter. But this time, instead of an immediate confirmation, they get a phone call. The supplier says, "We are experiencing tightness. The refineries are backed up. There's a delay on physical delivery." In that moment, the paper price on the screen becomes irrelevant to that procurement officer. They don't care if silver is trading at $25 on the COMEX. They care that they cannot get the metal they need to exist. Panic is contagious in supply chains. The moment one major player realizes physical metal is scarce, their mindset shifts instantly from just in time to just in case. They stop buying hand to mouth and start trying to secure strategic stockpiles. When industrial giants, whose demand is priced inelastic, start competing for a dwindling pool of physical metal, they bypass the paper market entirely. They go straight to the refineries and miners, bidding up the price of the real thing. This is the moment the paper market becomes irrelevant. This leads to a phenomenon known as decoupling. Currently, the price of a physical silver coin is roughly tied to the paper spot price, plus a small premium for manufacturing and dealer profit. When the industrial panic sets in, and the COMEX can no longer easily deliver metal, the connection between paper and physical snaps. You might look at your trading app and see silver trading at $35 an ounce. But if you try to buy a 1,000-ounce bar from a refinery, they might demand $70 an ounce. If you try to buy a silver eagle coin from a dealer, it might be $100 if they have any left. The paper price becomes a zombie number. It exists on a screen, but you cannot exchange it for real metal. We have seen this happen before in other markets. Look at rhodium, a niche industrial metal used in catalytic converters. When supply got tight and automakers had to have it, the price went from $700 to over $20,000 an ounce. The paper charts didn't matter. Industrial necessity dictated the price. In a decoupling scenario, those holding paper silver, ETFs that aren't fully allocated, unbacked futures contracts, or pooled bank accounts, may find out the hard way that they don't own metal. They own a financial claim that might be settled in cash at the lower, irrelevant paper price. Only those holding the physical metal participate in the true price discovery that happens when industry is desperate. So, back to our central question. Is it too late to buy cheap silver? If by cheap, you mean the artificially suppressed paper prices of the last decade, then yes, that window is likely closing rapidly, if not already shut. We are entering a new paradigm. The forces keeping silver down, leveraged paper trading, and excess above-ground stockpiles are exhausted. The forces pushing silver up, mandated green energy demand, and chronic production deficits are accelerating. Silver is retaking its historical role, not just as money, but as a strategic, critical industrial material that the modern world cannot function without. When geology and industrial mandates collide with a broken financial pricing model, the result is a violent upward revaluation. The banks haven't lost control to a conspiracy, they lost control to physics and math. The era of abundant, dirt-cheap silver is ending because it has to. The physical reality can no longer support the paper illusion. As always, this is not financial advice. The silver market is volatile and carries risk. But the data suggests that the fundamental landscape has changed forever. Do your own research, understand the difference between paper promises and physical reality, and decide where you want to be when the decoupling becomes undeniable. Thanks for watching. Disclaimer. The content of this video is for informational and educational purposes only and should not be construed as financial or investment advice. The views expressed are opinions based on market analysis and are subject to change. Trading and investing in precious metals involve substantial risk of loss and are not suitable for every investor. You should consult with a qualified financial advisor before making any investment decisions. The creators of this video are not responsible for any profits or losses resulting from your investment choices.